Hello, guys. Welcome to Traders Therapy Session. I'm your host, KRO. In today's session, guys, we're going to interpret ICT Market Maker buy model. Sorry for not including the sell model, is simply because the buy model, I'm seeing more of the buy model appearing on the current market. So I want to relate to the current market with these annotations or explanations rather. So without wasting any time, guys, just a little disclaimer. I am not a financial advisor, and no one is encouraged to utilize their own money to trade forex. And everyone should know that forex, trading forex or indices, futures, participation, in fact, in on a market, financial market, is risky. Some You can lose your money and you can make a lot of money, but you can lose all your money. So this is not a financial advice or some sort. This is just a educational video. Without wasting any time, guys, let us just get into market maker model. um I will confess, I first learned this model on 2022. Was it 2022? Because I guess if the first video on the 2022 model, this is what he's showing, where ICT buys and sells on a market on a curves. So without wasting any time, guys, let me just share with you here. Sorry for a moment. Without wasting any time, guys, let me share with you what I've discovered and pretty much what my journey came to. I wanted to learn market maker model because I realized that first, before that, the market maker model was the composite, before he even mentioned, was the composite of every strategy, meaning it was the higher level. If you understand 2022 and you were with in 2023, this was the last lesson the ICT left us with, which is market maker model. So let me just get into it. Everything else I will explain as I pass here. I try to make this thing as easy as possible, but when it comes to first part, I try to make this thing as little bit as complex, so that because you will not identify this at a go. So like ICT mentioned and said, it will take time for, it will be different to some of the students, maybe because I took time to learn 2022 and 2023 and repeated the models, took notes, applied. Maybe this is the reason why I came into this. And by the way, for confession, guys, this, I just landed into the understanding of this, and I hope that I lead someone like me who might want to see the real move of the market, because this is how the market moves. Without wasting any time, let's just get into it. I will annotate from 1 to 7, then we'll refer to these things, including the faces. If you want to understand the market maker model, guys, you need to, first thing first, step number 1. If it's the buy model, it means that we are buying. So step number 1 should be look for sales or wait for sales to occur, meaning this is sell side delivery. So wait for sales to occur, then take advantage of the buy, because this is a buy. This is where everything is occurring right here. So, but you can take advantage of this if you can identify it at the early stage. You can take advantage of the sell side of the curve and try to capitalize. But no one is encouraged to use their funds. Demo trading, you can utilize that one, because you are losing nothing and you are making nothing out of that except the experience. So as the market goes down, if you are able, please do not lose hope and say, no, this is hard and everything like that. Please, there are several steps, and in this thing, and you need to be aware that this is 2022, 2023. Every PDRA that ICT taught, it's applicable here. So you need to bring back that, you need to bring that knowledge together with it so that we can break this thing down. So what is happening? You see the original consolidation. Okay, let me mention this. This is a buy side of the curve. This is the sell side of the curve, and this is the buy side of the curve. So for sell side of the curve, if you want to take part, you want to participate on the sell side of the curve, you may ask, what will make me know that this is the market maker model? What will I see that will alert me, that will tip my hand and say, yes, come in, this is the market maker model? Do not worry, I got you covered on this one. You go on a higher time frame, and of which I will show you on the charts. You go on a higher time frame, and as you go on a higher time frame, you look at the draw on liquidity. Remember, that's number one goal. Let's say the market was coming into an inefficiency right here, or into an order block after having to take the lows. This is how I like it as well. After we took the low, I need an excuse for market to go up above. I don't just wait for market to take the low and just buy like that. No, below the low, there should be something that there should be a pivot, a real pivot point for market to turn. So somewhere around here, maybe the market took the low. Let's just, maybe for explanation purposes, let's say you had, let's change this to black. Let's say you had the all-time lows here. Okay. Let's just say you have all-time lows, whether it was relative equal lows or it was just the low, previous week low, previous day low. So as this was taken, below that lows, I need to see an excuse in a form of a PDRA for the market to go up. It might be here. It doesn't matter, guys. The reason why I want to put it here as a low is because I want to incorporate it with this cell right here. But it might also be here, maybe below, and I'm not referring to this, whatever is it that I've annotated. Let's just say let's just say there was a low here. You get what I'm saying? There was a low, market went up, and market is attacking that low. So if you saw something, a reversal here, you would know that here I would look for the point of interest is this one, and this is an excuse. You see? Let me blur this one. A little bit like this. Let's say you were taking relative equal lows. Excuse me, guys, for this one. You had a higher time frame relative equal lows. Let's say you had a higher time frame relative equal lows. Oh, let me put this to the left. I'm not going to edit this, guys. So you just have to deal with what the delays that we have. Okay, let's just say we had the relative equal lows, which is this right here. The market created a relative equal lows, and the market created a relative equal lows and pulled up. Then it met with some reversal. After that, market start to create this right here. You see a consolidation. Then after seeing a consolidation, this is an excuse maybe. Sometimes it happens. And with the example that I'm going to show you, this happens. Sometimes it just create an equal highs and equal lows and pull down. So it gives you an excuse to go down. Where will be your target? Your target should be the relative equal lows right here. Below the relative equal lows, you have a higher time frame PDRA again, as in a form of a fair value gap or an order block. So this is what you do. Your focus, your first focus should be on this point right here below. As you focus on the low here, whatever that is happening here, do not worry about it. Let the market come to what? To the higher time frame PDRA. So, but as this is formed like this, after you won't see it here, you won't see it here. You might likely see it after the break here and start to see that, oh, this was a consolidation. But because when it comes up, this is not a consolidation. You won't be able to see it. You won't be able to see it even here. But until maybe this is broken, maybe that's the time you're going to open your eye and say, oh, this was a consolidation, since this is a draw on liquidity. Then you can try to look for what? Phase 1. But guys, you shouldn't rush it. And if you start with this, you can let phase 1 go and target the phase 2, because this is just the confirmation. So phase 1 we done. Phase 2, expect to buy. Phase 1, you just expect to sell. Then let's go to part 1, number 1. What do we see here? Price will create relative equal highs, then go down to 3. 3 is this one. Price will create relative equal highs or consolidation, which is original consolidation. Just to go here, forget about whatever is happening here. The focus here to there. Then let's go to number 2. After the break of consolidation, actually number 2 is this sell, but it should be here. Number 2 says, after the break of original consolidation, wait for return or buy side liquidity for retail to do what? To trail their stops. After we break, wait for return to original consolidation, of which is what we have here. We went out, then the market returned. This is the return. Let me put it here. Okay. Wait for return to original consolidation for market to return into it. But sometimes it doesn't. It just leaves without a return. For buy side, for retail to trail their stops, let's go to number 3. Higher time frame PRA. Wait for confirmations before buying. As it gets here, do not rush. Guys, this is how I lost, even if with ICT studies, because sometimes we rush for market to come into a PDRA and we immediately buy. Yes, you can buy if you know what you are doing. You can buy as price is going down. But if you want to trade this, just wait for confirmations. Wait for confirmations before buying. Number 1 confirmation, it should be what? Smart money divergence. You want to see smart money divergence. What is the meaning of that? You see here, maybe let's just take it from here to here. You see the price created a low and created a high. But on other, let me just put here. This is NAS. You want to see US 30. You want to see Dow doing other thing. And then S&P. Okay. Forgive my typing, guys. Let's just say you are looking at this on Nasdaq. At this time, at this point, the market should, because these are correlating pairs or correlating assets. So as the market is going down, you expect the market to go down on US 30 as well. You expect the market to go down on S&P 500. But what happens is that you see this lower low right here. Let's say lower low here and the lower low here. But on US 30, after this lower low, you don't see this lower low. Market start to move high. What will happen here? Then that is a crack in a code. I just wanted to draw that, but I realized that will waste time. So this is what you look at before anything. That will be your first confirmation, which is smart money divergence. I guess maybe I will do short clips videos on smart money, on market maker model, so that I can get deep into each and everything here. But this is just an overall of it. Then let's go to 4. Oh, smart money divergence. And here, before going to 4, this is where you will see smart money reversal. Then you can utilize your 2022 model. You either here on what you are trading, if you may ask, you will get either a breaker, mitigation, power of 3. Those kind of things, you will get them right here. Those will inform your entry as you move forward. Entry on a fair value gap or order block after displacement. I didn't mention that one. At the right time. That is important, because sometimes it might be lunch seeing this entry, only to find out that the market will consolidate just after lunchtime. It will come into that fair value gap and move up away. So timing is everything when it comes to this. Let's go to number 5, of which is this part. So I didn't want to mention this, but let's talk about this this dashed gold lines. These are engineered buy-side liquidity. As the market is moving down, remember this is a drawn liquidity, but the lower lows and the lower highs, the ones that are created, these highs, the retail traders will do what? Will move their stops. Let's just say if the retail trader, and remember this, whether smart money or everything, the market will move to same direction. We are analyzing the same things, but in different annotations, maybe trying to get the better entries, better readings of the market, but the goal is to get the move of the market, whether being retailer, smart money trader, or doesn't matter. So market as it was creating lower lows, lower highs, according to retail. And I'm not marking on retails and saying retail is bad or good. I'm just saying according to retails, this is where you enter with your Fibonacci 61.8 or 38.2. It doesn't matter the structure. We enter, we go low. I would enter and go low. Hence, you see the sell as well. So here you find the market structure shift, of which I even taught before I landed into smart money trading on my free course that I post there, technical advanced course, on the very same YouTube channel. I taught this is the reason why I'm saying I'm not looking down on any trading style. What I'm just showing here, I'm showing you how the market will move, and you will go to any time frame in your chart, any day in your chart, and see these impulses and tell me if this is not how the market is doing. So as market is moving down, this is where your entries, but you're going to utilize these things on a second phase, on phase 2. How will you utilize this one? This is when we say we go after the stop losses. It goes, this stop loss is your target. This stop loss is your target. This stop loss is your target. This is when led me to explain number 5. Scale in or first entry if 4 was missed. So if you missed your entry here, do not worry. Remember this are the stop loss, and remember your original TP should be here. Your final TP should be here. So the market will move up as it breaks. Let me explain this. As it breaks this is an engineered buy-side liquidity. I will let the market to come down, not to take out this low right here. So my stop loss will be low. If I enter here, my stop loss will be below to be safer. But if you know your advanced entries, you could put your stop loss somewhere around inside here. So as it breaks here, my stop loss moves from where it was. Now it moves below this, knowing that the market won't come. And guys, if you go back and watch ICT, you would see this is how ICT puts when he's trading live. This is why how he puts his stop loss. Say, I do not expect the market to come below this. I put my trust on, I quote, well, he say, now I put my trust on this lows here. There was a recent trade that he took, but it was maybe a month ago, 2 months ago, when he was buying and utilized that. Now it's starting to ring a bell, and now it's starting to open. The light bulb in my mind goes on and say, oh, this is the reason why he said this. This is the reason why he said that. And another thing, I can see others are also, like me as well, trying to reteach what ICT has taught there, but I saw the gap, and it's what I want to fix right now. This is engineered buy-side liquidity. We utilize this. So this is when, number 1, this is when you will see the institutional order flow drills. This is when you will see the trap traders right here, because you will see a fair value gap that you expect to react, go down, but those fair value gaps are being violated. Then this becomes a balanced price range. Forgive me for not mentioning that one. I'm sorry. But I will mention it as we go to the charts. As it comes, it goes there. Let's go to number 6. Very high probability. Okay, very high probability to entry, especially if we miss these highs. We miss the TP. Remember, if we create relative equal highs relatively to original consolidation and market comes down, please, this is high probability entry going into this high. So if you're watching this, guys, let's just say now you say, where am I going to get this one? How will this work better for me? If you're watching this from a hourly perspective or 15-minute perspective, and this goes to day traders, you will know your daily entries. If you saw this on an hourly, you wait for the next day, you will get this entry right here. You got that entry, you get this entry, or you missed this entry, or you lost on this entry, thinking that the market will go up. But once the next day, once you realize that you have this one, then you go for the next entry here. You know the target is still intact. Maybe you get your entry, you went out, you go for another entry right here. Going for the target. Before it gets to the target, you get to the TP. Then you're done with it. You leave, you go out of the market. You don't do anything here. You wait for smart money reversal. Then maybe you might have a day off of trading here. Then the market comes into a fair value gap or an order block, which is a breaker, which is a mitigation, which is a power of 3. Then when you see that happening, what do? You take advantage of that. This is your first stage accumulation. This is your first entry. Then maybe you find the consolidation a little bit as it moves on a lower time frame. This is what's nice about it. Whatever that you see me explaining here, it also occurs in a lower time frame. You can utilize same structures but in a lower time frame to get your better entries. So your fair value gap, then you get your entry right here. Then it goes high. What do you target? You target these highs. 50% of this, I forget to mention, and ICT didn't mention this on the current market maker model he teach, but on most of his videos he's mentioning this one, guys. Right, as you get here, above 50% of this is what ICT teaches, and it tells that you should take half of your position off and put the stops on an entry. And it will make sense that if the market breaks this and if I break even, it shouldn't even go below this. If it breaks 50%, I mean to say not below that. Sorry, forgive me on that one. I'm just trying to be perfect into this so that, but not say that I will be perfect, but I'm just trying to be as perfect as possible so that everyone could just follow. After 50% of this, you should take, that's what we learned before this. You should take what? You should take 50% off and break even. Let's see breaking even if it makes sense. I've entered here. I've put my stop loss here. And then what did I mention before? Few minutes ago away. I said it should not take this low. So it now, then the bulb now comes on. Then what happens is that we get this. As it breaks here, the stop loss should go below this. Then I get my entry, whether below 50% or institutional order flow, it really doesn't matter. I get my entry until I get here. Guys, make sure that you understand that part before I bring another part, another phase into what I've just explained, because this is two-sided. As it breaks, you wait for your entries, but sometimes you don't see the entries here and you see the market going up. What informed those entries? Because no market does not just go up. This is an algorithm, guys. You utilize these entries in a reverse. This is where your invasion order or invasion fair value gaps comes in. Propulsion order blocks comes in. If there was an order block here that let the market goes down, you utilize that order block after broken in a reverse form to go up. Or invasion or fair value gap was left, you utilize that invasion fair value gap for market to go up, because it was not just left, because if it's an invasion fair value gap, it means it was a fair value gap. Let's just say it was a fair value gap right here. Just for the sake of this, let's just say it was a fair value gap right here. Guys, like I mentioned, you need to know just a handful of what ICT has taught so that you can be able to relate to what I'm saying, because there are no charts here. Let's say there's a fair value gap right here. And then as the market is going and it's on 50% and it occurs on 50%, if you get your leg like this, try to mark 50% and tell me that it's not likely to see a fair value gap on 50%. So as it occurs on 50%, this is where you take half of your position off, because it can come just here, 60 or 62%, and go down. If you are wrong, you break even. So this is what you should expect, because you need to think ahead. This being violated and price comes back to it, respect the low of this, but it can gives the weak, it doesn't matter, then pull up. That's where you get your re-entry. You start to take your stop loss, put it here. As it moves above here, stop loss is below here. You can enter here, you can get your last entry here. Then, not the last entry, you can get your entry here. The last entry, sorry for that. The last entry, you can get it here, and then start as it breaks the highs. Now you can start to peel off until you get to the target. Guys, I hope that made sense. And I thought I will drag this video, maybe trying to show you the next one on a daily and try to show you the intraday entries. But I guess I will make a separate video on that one. Now let's move to the chart annotations. And please pause this thing, take a screenshot, try to annotate it yourself before even going here. Then as we do, and do the same as we go to the chart videos, you can pause the video and annotate this yourself, your way, summarize it the way you know. This is final TP, need to align with your standard deviations. Oh, how do you get your standard deviations? Sorry. You take this right here, this high to that high right there. As you take that high to that right there, you'll get negative 1.5. I didn't put it here. Negative 2 and maybe negative 2.5. Let's go to the settings and let me just put negative 1.5 here, because this will help a lot once the price breaks the high. Negative 1.5, and let me put again negative 2.5 right here. Negative 2.5. And I am not saying the way that I drew my my charts, they go they align exactly as the market, but most likely when we draw these things, they just go with this. So you got negative 1.5, and then you'll get your negative 2.5 right here. That will be your final TP. On this one again, I will make a separate videos on standard deviations and everything, because it's another gain. It's another way you measure this leg. The one that caused the low will give you the TP, the TPs. So without wasting any time, guys, you took a screenshot, you annotated. Now let's go to the chart videos, and I will only do that on a daily. But trust me, I will utilize on the second series of this video, the part 2 of this video. I will take the very same daily, make sure that you understand this, and break it down to the hourly time frame. Sorry for that. And then you will get the idea that this occurs in any time frame that you can think of. So now let's go to the chart videos. Okay, let me try to adjust this as possible as I can. Okay, let's see everything. Remember those annotations, guys. Let's just go to this and copy them. Okay, let us just put them here so that they can help us reading the price. so that they can be of help. We said phase 1. Okay, guys, this is Nasdaq futures. The current market, we are reading it from Wednesday, the 30th of August. It's a daily up to the current day, which was Friday, the 23rd of November 2023, if you catch this thing later than this day. Okay, guys, and I'm reading this on weekend. The market is closed. So on this, guys, on this one, let us try to follow. We have phase 1 and phase 2 right here. What do we have? On phase 1, we expect the what? On phase 1, we expect to sell. Let's see how we can sell. Original consolidation we have right here. And an excuse, guys. Remember, I told you about an excuse. And how you're going to mark your consolidation, guys, will vary. Trust me. Some will say this, as this broke, this will be my consolidation. And then I take everything here as my consolidation, as original consolidation. This is still fine, guys, because you will still have, if this is your original consolidation, you have a break, and then you have a return to original consolidation. Still, this is a return. Then you go low. So that will still be fine if you utilize that. But for me, I'm just picking the small one that my eye jumped to. The reason why, and like I mentioned before this consolidation, before this, we have a fair value gap which performed, the low was taken, and then it returned to fair value gap, which was the second and fair value gap. Then market consolidated. This was an excuse for market to go further down. So let's focus on what we have. Number 1, price will create relative equal highs, then go down to 3. Remember, we have number 1 here, we have number 3 here. Relative equal highs, you can say these are relative equal highs, then go down to 3. Right? Then number 2, after the break of original consolidation, wait for return or expect the spool immediately and engineering of buy-side liquidity. The highs, these highs, buy-side liquidity, like I mentioned them here. So let me just explain. This we will read before. We will read on the other side. Let me just explain this one. After the break, look at this fair value gap right here. This low and this high, it was never, ever, ever tested. Then the market lift this so that it can come back again. As it gets into this fair value gap, what happens? As it gets into this fair value gap, then this is the return to the fair value gap. That's when you get your first entry sell. If you are interested in this, or wait until the market gets here, then see everything, then utilize this as this. I would say phase 2 is high probability than phase 1, because phase 1 you are still the part of creation. You are creating. You are like, you can lose a lot here than compared to this side, because this is a buy market maker buy model. You see. Then you get your first entry here. The market spools down. We have the lows. We have the evidence that we want to go down because we took out the low. After taking out the low with the displacement, after the displacement, the return to the fair value gap right here, not just any return. Then we go down to number 3. As easy as that, guys. Then when you get to your higher time frame, okay, maybe some of you say, how do I enter here? Do I have a replay here? Okay, I'll just have to remove this. Let us not just replay. Let us come here. Some of you might be worried and say, let's just say I see this consolidation, but you might not even expect it to be that consolidation, because another thing, for me, again, this is a second-hand fair value gap. So on a second-hand fair value gap, I might also expect the price to do what? I'm also expecting the price to even violate this thing, to just go to this, because there's an interest, this is a point of interest. I have a liquidity void right here. volume imbalance, I mean to say right here. So what do I do now? I am selling this, but it's a low probability entry. I do not know, guys. Trust me. I do not know this will go here until I see certain things. So any sell that I take here, I might take a sell here and then wait for this or 50% consequent encouragement of this just to go out. Those days of lowest hanging fruit, closest hanging fruit, I mean to say. Then once this consolidation was broken on the next day, I will wait for market. Let's just say this is respected. Remember, I will wait for market to do what? I will wait for market to get into this. Maybe if we want to disrespect this or get into the 50% of it. So I'm just waiting here. As I'm waiting, the market spools. Then what happens to a trader? I waited for the, sorry, I waited. I'm also covering psychology here, guys. I waited for the trade to get here. Now the trade got into my TP. I didn't get a trade. I lost it. I did what? And even here, guys, you can get a market maker model as well to go back up and to come back down on a lower time frame than this one. Whatever it is that I'm explaining, if you can get the structure, trust me. So once I see price coming here, it took out this lows. Just right there. This for me, two ways. Now the price is two ways. The price will go into higher time frame PDRA. That's when the I, for me, this is when I start, sorry guys, to see market maker model. This is where the green light starts to shine. Let me put it here. At this stage, this is where I start to see market maker model. Why? Now, it will only come in here and it is not yet market maker model. This is when I start to see it happening. Remember this, let's say this we don't have. We have market like this alone. Now, the market is here and I have to trade. What is the rule number one? What is the first rule? Draw on liquidity. I have a fair value gap that I tested, but it's still not filled. And I have a second fair value gap of which it has an order block as well. After that fair value gap, I had a gap right there. This is what made me even miss the buy because I was so glued into this gap for market to test at least this gap. So what happens? Sorry for that, before we go up. And I also have, remember that I mentioned here, I also have what? Now I have invasion fair value gap. You see? The fair value gap is being invaded here. I have a fair value gap, fair value gap right here. But I have a fair value gap that I left after we leave consolidation. That is the only time when I start to think of market maker, if this could be a market maker model. So it's the reason why I say, compared to buy side, the sell side of the curve, it's more tougher than the buy side, but you can do both. You can sell and buy as you get engaged to it. But I would advise the buy side first. So then let experience comes with the sell side. If it's a buy model, then the market comes. Once the market fails and creates the equal lows here, remember on the presentation back on the previous chart where there are only drawings, I mentioned that there will be relative equal lows excuse, but below that excuse there should be a PDRA for market to reverse. So this is what I mentioned, and I drew the line before I started. You can remember I drew this line. It's not a deja vu, guys, if you see this happening. Then I said this is relative equal lows. Let's make it stand out. Then I said you would have relative equal lows to be taken. Below, you need to have an excuse for market to go down. So if I have relative equal lows like this one right here, sorry guys for the development of the model. This shows that I'm giving you my understanding, and this is what opened my eye. Like, I'm very, very thankful for the last departing lesson from ICT. Like, that made me, and it was going to take me time because I was aware of market maker model, but I only drew it using the head and shoulder because I could recognize the head and shoulder pattern. And then after that consolidation, it will spool high. A pennant, this is what I was reading, and this is what is occurring. A pennant, after pennant, I would have a flag going to the direction of a higher time frame PDRA. Then I would get a flag. The flag, I know it was the last stage. After a flag, that was a TP. If you are a retail trader and you trade price action patterns, look at such things, and you will see a flag. You will see a flag, then consolidation. After a flag, before anything and everything, you will see a pennant before it reverses. Then after a pennant, and so such. Then this is a flag, and after a flag, it's gone. So this is a pennant. This is what I used to see, but I am not emphasizing this, guys. Let me not even draw it. You can see this right here. This would be a pennant. Maybe taking it any way that you want to take, or take it like this. This is a pennant. After a pennant, you see what? A bearish flag again. Then that was the last TP. That was how I was recognizing it. But I needed the reasons, and these are the reasons. So me, with knowing what is happening, what would happen, having more information, this brings more confidence in what I'm doing. So guys, it went down. As it goes down, now you start to see this. This is when my eyes start to open. This is when I start to annotate the sell side curve. After this fails to go here, it goes above. This is where I start to annotate. You might take it from here and see if I say, look at this, it will work. However, somebody might say, no, this is my consolidation. See how this thing works. You take it because relative equal lows, and then it consolidated, and then this was a break inside the curve. After the break inside the curve, the return, it might be out, but you still have it. The return excuses the second and fair value gap. You'd still be in the market because you know this is a engineered buy side liquidity. So you'd still get it here. And then remember, your stops still be intact. You'd still get it, but this is how I love to take it, to utilize it. I like the one that stands out for me. I would get the sell here if it went into a fair value gap, but it did not. So the second part, it went into a fair value gap. That's when you get your sells, and then you sell from this point. Your stops above or above here, then you target this. Then it's around 1:3, 1:4. That's how it works, guys. And if you are more advanced, you would take, let's just measure this. If you're more advanced, you would take your entry here. What's going on with the shift here? You take your entry here, maybe above this, or let's just say above this. You have like 20 ticks, 1,000 ticks. That will go to your TP. And my TP was this, but it missed. It was 5,000 pips, 5,000 ticks, 5,200 ticks. So that's 1:5, 1:4. That's how it goes, guys. Like, it cannot get any better than this, unless if you go to the lower time frame and try to choke your trades. But the nicest thing is that if you get it here, as it goes down, and you are confident about this, as it goes down, you see a re-entry. You get the re-entry here. You are trusting that the market, the price, you trust that the price will not go above this candle or above this right here. You have 604. maybe consequent encouragement or order block, 600 for 2.8. That's also 1:4 again. You see, as you get your cells there, 1, 2 cells. So now it gets into this. I hope now you understand. There's a draw on liquidity. There's an excuse for me. They are both draw on liquidity. There's a draw on liquidity because relative equal lows, but there's an excuse for me for market to reverse. When the market gets here, guys, unfortunately here, I won't be able to explain for this. The reason why I've put only this, because you need to go to lower time frame. Remember, I mentioned that this is a higher time frame PDRA. So if there's a higher time frame PDRA, you go to lower time frame, then here you will see smart money reversal. Because here you would have missed it. Remember, it went here. The only entry that comes is here. I talked about the trapped traders here. If you see, look at this fair value gap right here. This fair value gap aligns with this fair value gap. So what do you know? What do we know from that? This is a balanced price range. Then this becomes your trapped traders. So as it goes above, you wait. Please, guys. Entry after SMT divergence. Like I mentioned, if you see lower lows and then one of the 3 pairs crack the correlation, it goes away. That means that's a confirmation for you to go in. And you go for the one that did not break the low. Reason why is because if this was an Nasdaq and you see S&P did not break the low, you would go for an S&P as well. Why? Because S&P will run faster to the TP. So you look for the crack. Then after that, you want to see smart money reversal. After seeing smart money reversal, you utilize any model, 2022 model. Anything, whether power of 3, breaker mitigation, utilize that as your entry because this has confirmed. This, guys, you shouldn't worry as you come into this trade. This, yes, you might have some adrenaline rush as entering this, but as it comes here, this should be right here. This should be the part where you start to gain more confidence, saying, if I enter here, I know my original TP, my final TP is here. This is a TP for sales. This is a TP for buys. Then as you go above, remember what we talked about. The highs, remember we go low. The highs that we have until the TP, the highs that we have is what? Engineered buy-side liquidity. And I will talk about this one when we get here. When you go to your lower time frame, I'm not going to do this on this video, guys. Please forgive me, but I will do it on the next video that I will post where I will utilize the same price, but going to the lower time frame, trying to get this. Remember, what you have to take note of is this. Remember, this is a higher time frame PDRA. As we go high, we came back here. You got your entry. You get your second entry. This is where it shines. Look at here. Engineered buy-side liquidity. Very powerful, very powerful signature. Now you're going to focus on relative equal highs. Look at these highs. They were not taken out. And the price came into a fair value gap. Look what you have here. You have an order block that was supposed to perform here, but it did not perform. It tested the order block at the reverse part, what we used to call a propulsion block. Then it came back in. Hence, I said there are many sides there are 2 faces to interpret these things right here. These dotted lines. Interpret them that once the price takes this, it shouldn't go back to this low. Once it takes this second one, it shouldn't go back to this low. So what happens? You got your entry right here. Fair value gap plus. It's a bonus to go above. Now you know that you take this high. You are going after this high. You shouldn't come for this high. Your stop loss is below here. You protected the second fair value gap right here. But with this right here, you can just minimize your stops. Enter here, stops here. It shouldn't go into this. At least right below the 50%. It shouldn't go below this. Then after your entry, then you go above. Then you broke this one. You may ask, how did I enter this? Remember, how could I enter this? Remember, it was a second hand fair value gap. Now it's a third hand. a light bulb goes on, violated, as I explained before, retest, look at the candles respecting the lows, like I mentioned on the drawing. Now we take the final. Now we go to our destination. Then boom, we take the final TP. Guys, I hope this made sense to you. The next video that I will make, I will go to the lower time frame and share with you this SMT divergent, because this is what is missing here. I'll go to the lower time frame and try to share with you this in details, and then maybe try to share with you what occurred before this. But I will show you from here. I will take it maybe from here or maybe from here. I will see where the consolidation, where the original consolidation occurs. So after the reverse, then you go in. Guys, like I mentioned, this occurs in any time frame. You can get this on 1 minute, 5 minutes, hourly time frame. Once you get this, as long as you know your PD array, your higher time frame PD array, where the market is likely to draw to, then you start to look at that. Then after it draw to that level, that's when you start to look at the buys. And this teaches you another thing again. As the market gets into this area right here, what you need to do is that you need to focus. Do not immediately take a trade. Not yet, at least. Don't take a trade yet as it goes down here. This is an entry, I agree, but not yet. Not as yet. Wait for this until you crack the codes for this. This is all about cracking the codes of algorithm. Until the day you crack the codes of this and you see it happening and you're confident of that, then you know you can master, you know that you are mastering this, and then you can utilize that as your what can I say, sniper entry, tight stop loss entry, high risk to reward entries. That's when you can crack the code, and that after cracking the codes, that's when you can take advantage. But for now, utilize this and see where the price led us to. So without wasting any time, guys, let me see you on the next video, and I will give this a channel, call it a Market Maker series. Yes, I guess Market Maker Model series, not Market Maker series, because I guess ICT has Market Maker series, Market Maker Model series. Without wasting any time, guys, let me see you on the next video.